There is a number that should terrify every ute owner in Australia. Some of the most popular utes sitting in driveways right now will shed 30 to 40% of their value inside 24 months. Not because they break down, not because they're badly built, but because the market underneath them is shifting faster than it has in 30 years. By the time most owners figure out what's happening, the damage is already done and the trade-in offer is already embarrassing. Why? Depreciation matters more than reliability. The ute market has always run on a simple promise. You buy something tough, you work it hard, and when you're done, it holds its value better than almost anything else on four wheels. That promise is why Australians keep choosing utes over sedans, wagons, and SUVs at a rate that makes the rest of the world raise an eyebrow. It's baked into the culture. A ute isn't just a vehicle, it's a financial decision dressed up in steel and a tow bar. That promise kept the Hilux and the Ranger at the top of the sales charts for years running. It kept dealers confident and owners comfortable. It meant that even if you slightly overpaid at purchase, the resale would eventually bail you out. Plenty of blokes bought utes in 2019 and sold them in 2022 for more than they paid. That actually happened. The used car bubble was that real. That bubble has now fully deflated, and what's replacing it isn't a soft landing, it's a structural shift in the segment that is going to hit specific models harder than most owners currently understand. Here is what is actually happening underneath the surface. The Australian ute market is being pressured from three directions at once, and none of them are slowing down. First, Chinese brands are arriving in volume with real tow ratings, real payload, and price tags that undercut the establishment by $15,000 to $20,000 on comparable specs. That is not a niche disruption. That is a category level challenge. Second, electric and hybrid drivetrains are coming into the segment whether the traditional ute buyer wants them or not, and every announcement of an electric variant puts quiet downward pressure on the resale value of the diesel sitting in your driveway right now. Third, and most immediately, the used car market correction that began in late 2023 is still working its way through the system. Values that looked completely solid 18 months ago are softening in real time, and some specific models are not softening gently. They are heading off a cliff. Now, before we get into the list, I want to be precise about something because it matters for how you hear everything that follows. Depreciation and reliability are not the same conversation. A quick word before we go on. Most people spend thousands of dollars repairing cars long before they actually need to. Professional mechanics have known for decades that a handful of simple habits can make almost any vehicle last far longer. And I've gathered 101 of those insider secrets into a book called The Mechanic's Bible. I won't mention it again. If you'd like a copy, the link is in the description. They are related, but they are not identical. And treating them as the same thing is how owners end up making expensive mistakes in both directions. Some of the utes on this list are genuinely decent vehicles. Some of them have earned their reputations the hard way through years of documented performance in Australian conditions, but a good ute that the used market doesn't want to pay a premium for is still a financial trap, and that trap is just as expensive as buying something unreliable. And this video is about protecting your investment. It is about understanding what the market is doing before the market explains it to you through a trade-in offer that makes your stomach drop. That number is coming for some of these owners. The only question is whether they see it in time to act. The rules of the game. Every pick on this list is based on real market data. We're looking at current private sale and dealer trade-in spreads from Australian used car platforms. We're cross-referencing with registration numbers and new sales volumes that tell you how much supply is coming into the used market. We're factoring in brand trajectory, parts availability, incoming competition, and the structural changes in the segment that make certain models more exposed than others. We're going from concerning to genuinely sell it now, And if you're currently making payments on one of the Utes near the top of this list, I'd encourage you to stay with me to the end, because the difference between selling in the next 6 months and waiting another year could cost you more than most Australians spend on a family holiday, right? From concerning to sell it now. Number 8, GWM Cannon. The GWM Cannon came into Australia swinging hard on price. It promised dual cab practicality, a reasonable tow rating, and a features list that embarrassed vehicles costing 15 grand more. For a window of time, that value proposition was genuinely hard to argue with. Here is why that window is closing fast. The resale problem with the Cannon isn't about what it is today, it's about what the used market thinks it's going to be worth in 2 or 3 years, and that calculation has turned ugly. GWM is not standing still. New models are arriving regularly, each one making the previous generation look older faster than a Japanese brand ever would. When a brand updates its lineup every 18 to 24 months, the used version of the previous model gets caught in the crossfire every single time. There's another layer to this. Australian buyers shopping used Utes are still, in large numbers, deeply suspicious of Chinese brands at the higher price points. A new Cannon at $38,000 feels like a calculated risk that some buyers are willing to take. A used Cannon at $25,000 with no remaining factory warranty and thin dealer support if you're outside a capital city is a much harder sell to a much smaller audience. I've looked at private sale listings from the last 6 months, and the spread between what Cannon owners are asking and what they're actually getting tells a story. The gap is wide, it's widening, and Cannon owners who bought early are starting to feel it. If you're in a Cannon and you've been considering a change, the best time to have that conversation with yourself was 6 months ago. The second best time is right now. Number 7, Mitsubishi Triton. The Triton has been part of the Australian ute market since 1978. That's not a typo. Nearly 5 decades of Tritons working on farms, job sites, and school runs across this country. But longevity in a market and value retention are two very different things, and the current generation Triton is walking into a depreciation problem it didn't fully earn. Here's the core issue. Mitsubishi's share of the ute segment has been slowly but steadily contracting for years. When your brand's market position is shrinking, the used values follow. It's almost mechanical in how predictably it happens. The Triton also sits in an uncomfortable middle ground. It's not cheap enough to win on price the way the Chinese entrants can. It's not prestigious enough to command the premium that buyers attach to a Hilux or a Ranger. It occupies a position in the segment that's getting squeezed from both directions simultaneously, and that squeeze shows up directly in trade-in offers. I'll say this honestly because the Triton deserves it. The current generation is a materially better vehicle than what came before it. Mitsubishi genuinely lifted their game. Better ride, better kit, better interior. But better doesn't automatically translate to stronger residuals when the brand narrative hasn't caught up. Buyers make decisions based on perception as much as reality, and the perception of the Triton in the used market is still dragging the baggage of the previous generation behind it. If you bought a current Triton expecting Hilux-like resale, the numbers coming back from dealers right now are going to be an uncomfortable read. The gap between expectation and reality on this one is real. Number 6, LDVT60. The LDVT60 never promised to be a residual value champion. Nobody walked into an LDV dealership expecting to find a hidden gem that would hold its money like a Hilux. The pitch was always simpler and more honest than that. Spend less upfront, get a working ute, accept the trade-offs that come with a brand that's still building its Australian reputation. For buyers who understood that equation clearly, it was a legitimate call, and plenty of them made it with open eyes. The problem is what has happened to that equation since the purchase. LDV's reputation in Australia has taken documented hits that go well beyond the usual teething problems of a newer brand finding its feet. The throttle hesitation issue became a genuine controversy, with multiple owners describing the delay off the line as the most dangerous thing they had experienced in any vehicle. Not uncomfortable, not annoying, dangerous. Then came the rust concerns, corrosion appearing on vehicles only a few years old in conditions that a working Australian ute should handle without blinking. And then LDV itself publicly acknowledged that corrosion was a problem on certain examples, which is the kind of admission that echoes through the used car market for years. You cannot unring that bell. Once the word rust is formally attached to your brand in the Australian press, used buyers remember it every time they open a listing. Here is where it gets specifically painful for current T60 owners, and I say this with genuine sympathy because a lot of hardworking people bought these things in good faith. The brand has moved on and left the original T60 behind. LDV is now pushing the T60 Max, updated variants, new positioning, new marketing, all of which is entirely normal business behavior, except that it means the original T60 is being actively made to look outdated by its own manufacturer, while it's still sitting in owners' driveways with finance owing on them. Depreciation on the T60 has been running hot for the last 12 months. Private sellers trying to achieve even 60% of their original purchase price are finding it requires patience, the right buyer, and frankly, a bit of luck. Dealer trade-in offers on anything with serious kilometres are genuinely confronting numbers. One owner described the trade-in conversation to me as feeling like a mugging in slow motion. I don't think that's an exaggeration. That's precisely what happens when brand momentum shifts and the model you're holding gets left on the wrong side of that shift. If you have a T60 sitting in the driveway and you are approaching the end of your finance term, the time to act is now. This trajectory does not improve from here. Number 5, Nissan Navara. The Nissan Navara is a genuinely interesting depreciation case study. It has a loyal following, a reasonable track record across the segment, and a manufacturer that hasn't walked away from it the way some brands have quietly abandoned their ute programs when the going got difficult. On paper, those are stabilizing factors. In practice, none of them are enough to protect Navara owners from what the used market is currently doing to their asset. Start with the product itself, because the product is part of the story. The Navara's rear leaf spring setup has been a long-running criticism from reviewers, owners, and mechanics alike, and it hasn't gone away because the criticism is legitimate. In a segment where coil rear suspension is increasingly the norm, running leaf springs on a ute that's marketed as a daily driver as much as a workhorse is a genuine mark against the ownership experience. It's not invisible either. Buyers who test drive a Navara back-to-back against a current Ranger or any of the newer generation competitors notice the difference immediately and without prompting. That comparison costs the Navara every single time it happens, and it happens constantly in dealerships and private driveways across the country. The bigger structural problem for Navara residuals isn't the suspension though, it's Nissan's own position in the Australian market and the direction that position is travelling. Nissan has been contracting here for several years. Dealerships have been rationalised. The network that backs up your ownership experience, parts availability, warranty support, the ability to get your ute serviced in a regional town without driving 2 hours, is measurably thinner than it was 5 years ago. And when a brand's network thins, used values follow that contraction with a reliability that should terrify anyone currently holding the asset. We watched this pattern play out in slow motion with Holden. Nissan is not Holden, and I'm not suggesting it is, but the direction of travel matters when you're trying to calculate what your ute will fetch in 2027. Then there's the competitive reality of the used market itself. When a buyer is choosing between a used Navara and a used Hilux at comparable pricing, the Hilux wins that conversation the overwhelming majority of the time. That dynamic locks a permanent discount into the Navara's position that owners simply have to accept to move the vehicle. Oil leaks that dealers have quietly acknowledged, a rear end that droops under load, and a tightening brand network. Those are not the ingredients for healthy residuals, and the 2027 outlook reflects exactly that. Number 4. Volkswagen Amarok. The Amarok is the ute that makes automotive journalists write poetry. It drives beautifully. The interior feels like it belongs in something that costs twice as much. The new generation's shared bones with the Ford Ranger brought genuine engineering credibility to what was already a compelling package. And here is the problem with a ute that drives beautifully. Running costs. The Amarok's servicing costs sit materially above what Hilux and Ranger owners pay. Labour rates at VW specialists are higher. Parts pricing is higher. The specialist knowledge required to work on it properly is not evenly distributed across the country. Get away from a capital city, and finding a workshop that can fully diagnose and repair a current Amarok without sending something interstate is a genuine challenge. Here's the depreciation mechanism that matters. When buyers shop used utes, they price in future ownership costs. A used Amarok buyer who knows what they're doing sits down, calculates the delta between Amarok running costs and Hilux running costs over 5 years, and discounts the Amarok's purchase price accordingly. That discount is now running at a level that should worry current owners. There's also a supply story here. VW has been pushing hard volume through the Amarok in Australia. More new Amaroks sold means more used Amaroks entering the market in 2 to 3 years. More supply, same demand, lower prices. The maths of this is not complicated, and it is not kind to current owners. The Amarok will always have its devotees. I genuinely understand why, but devotion doesn't pay your trade-in shortfall, and the gap between what Amarok owners expect to get and what the market is currently offering is growing. Lovely ute, difficult asset. Number 3, Isuzu D-Max. Right, this is the one that's going to get me the most grief in the comments, and I accept that entirely. The D-Max is genuinely well regarded. The mechanic community respects it. The farming community trusts it. The reputation it has built over decades is legitimate, and it was earned the hard way. But here's the thing about strong reputations. They can carry a vehicle's value for a long time, and then the structural factors catch up all at once. And for the D-Max, heading into 2027, I think we're approaching that moment. The current generation D-Max brought more complexity, more electronics, more driver assist systems, more sensors and modules that owners and mechanics are already flagging. There have been reported concerns about cracks near the suspension towers on some current generation vehicles. The driver assist systems have attracted complaints about overeager intervention. Neither of these is catastrophic in isolation. Combined, they are the beginning of a reputation shift. Here is the bigger picture. Isuzu's D-Max success in Australia has been built on one core proposition: simple, tough, reliable, and cheap to own. The moment buyers start questioning any part of that equation, the used value premium that the D-Max commands starts to erode. Premium residuals require premium confidence. Cracks, literally and figuratively, in that confidence story are expensive for owners. I want to be fair here. The D-Max at number 3 is not a disaster. It is a warning. It is the ute most likely to surprise its owners with weaker than expected residuals in 2027 if the reputation narrative continues to shift. Owners who bought at the top of the used car bubble and are now considering trading should check what the market is currently offering against what they expected. I suspect some of those conversations are already happening. Number 2, Ford Ranger. I can already hear half the comments section loading up. The Ranger is the best-selling vehicle in Australia. How does the best-selling vehicle in the country end up at number 2 on a depreciation warning list? Let me explain the mechanism because it matters. The Ranger's extraordinary sales volume is precisely the reason its used values are under pressure. Every month that record-breaking new Ranger sales continue, another wave of future used supply is being created. The used car market for the Ranger in 2027 is going to be flooded. Absolute volume of stock suppresses prices. This is not an opinion. It is how used car markets function. Then there's the recall history. And I have to be straight with you here because the list is long. A recall covering nearly 13,500 Ranger and Everest vehicles over a camshaft sprocket that could fracture and stall the engine. A transmission software recall where the gearbox could shift to park while the vehicle was still moving, a brake boost software recall, airbag recalls, an ECM fault that drops the engine into limp mode in hot conditions. Every single one of these recall notices becomes part of the vehicle's documented history, and buyers of used ranges are increasingly aware of them. Here's the thing about recall-heavy models. They don't kill used values overnight. What they do is create hesitation in buyers, and hesitation means negotiating room, and negotiating room means lower prices for sellers. The used Ranger buyer who pulls up the recall history before making an offer is using that list as leverage. Current Ranger owners are on the wrong end of that leverage. The Ranger is still a good ute, I'm not walking away from that, but good ute and smart financial asset are two conversations that have been diverging for the last 18 months, and the gap is now wide enough that owners should be paying attention. Volume, recalls, and a used market that is filling up faster than demand can absorb. That's the combination that puts the Ranger at number 2. Number 1, Toyota Hilux. Here it is, the one that will absolutely 100% generate the most passionate responses in the comments. The Hilux, the legend, the ute that survived wars, crossed deserts, and built a reputation so durable that it became the marketing line, unbreakable. I'm not here to tell you the Hilux is a bad ute. I'm here to tell you that the Hilux's depreciation outlook heading into 2027 is more exposed than almost any owner currently believes, and the gap between the reputation and the incoming reality is the single most dangerous financial blind spot in the Australian ute market right now. Start with the DPF class action. Hundreds of thousands of Hilux, Fortuner, and Prado vehicles caught up in a class action over diesel particulate filters that owners reported were clogging, killing power, drinking fuel, and blowing white smoke. Toyota extended warranties and fitted manual regeneration buttons. The legal fight ran for years. That saga rewrote the public narrative around the Hilux for a generation of owners who believed the badge meant something close to mechanical invincibility. Then, just recently, Toyota recalled over 13,000 new generation Hilux utes over a wiring fault on accessory bull bars that the recall notice itself said could cause loss of power steering and, in their own words, an accident resulting in injury or death. That is not a minor recall. That is a manufacturer formally acknowledging that a specific configuration of their flagship product could kill someone. The Hilux badge does not make that sentence smaller. And here is where the depreciation story becomes specific. The Hilux has historically commanded a used value premium over virtually every other ute in the segment. Buyers paid more for used Hilux because they trusted the name. That trust premium is now being eroded by the documented reality of DPF issues, the recall history, and the incoming wave of new competition from Chinese brands and updated rivals that are closing the gap on the things Hilux was supposed to own exclusively. Let me put a number to this. The Hilux premium over a comparable used Navara or Triton in the used market has historically run at 10 to 15%. That premium is compressing. Buyers who were automatically reaching for the Hilux are now pausing, comparing, and in growing numbers choosing differently. There's also a specific demographic shift happening. The Hilux's core buyer base, tradies, farmers, regional drivers who genuinely need a working ute, is increasingly looking at what Chinese alternatives offer for the money. A percentage of those buyers are now buying Chinese at the new car end. That shifts the composition of used Hilux demand over time. Less competition for used stock means less upward pressure on prices. I'll say it plainly because this is the point where the reputation gets in the way of the analysis. Owning a Hilux is not the same hedge it was in 2015. The market has changed around it. The recall history has complicated the narrative. The competition has closed the gap. and the owners who are most exposed are the ones who bought at peak prices through 2021 and 2022, when the used car bubble inflated values to levels the market is now correcting away from. If you've got a Hilux and you bought it at peak, the current trade-in offers are not a mistake. They are the market telling you what it's worth at this moment in the cycle. The question is whether you wait and hope the cycle turns or you act. While there's still a reasonable number on the table, waiting has a cost. That cost compounds every month you hold the vehicle while the market moves against you. I'm not telling you to panic. I'm telling you to look at the actual numbers with clear eyes, because the badge on the tailgate is not going to shield you from what's happening in the used market right now. Honest takeaway. So there they are. 8 Utes with real depreciation risk heading into 2027. The GWM Cannon caught between Chinese model cycles and thin used market demand. The Triton squeezed between the budget brands and the premium players with nowhere comfortable to sit. The LDV T60 carrying brand reputation damage and a manufacturer that's already moved on. The Navara facing a contracting dealer network and a used market that automatically discounts it against the segment leaders. The Amarok with its premium running costs and a supply pipeline that's filling the used market faster than demand can absorb. The D-Max at the beginning of a reputation shift it hasn't fully felt yet. The Ranger drowning in its own volume and recall history. And sitting at number 1, the Hilux, the most trusted name in the game, now facing the gap between its reputation and its documented reality in the most consequential way possible. My honest takeaway, and it's the same one I give every time, none of these Utes are necessarily bad vehicles to own. Some of them are genuinely excellent at the job they were built for, but a vehicle's reliability and a vehicle's financial trajectory are separate conversations, and too many Australian Ute buyers are only having one of them. The Ute market is in the middle of a structural shift. Chinese brands are real, EV and hybrid drivetrains are coming, the used car bubble has burst. The owners who walk away from this well are the ones who checked the actual market data instead of the badge mythology. Your mate at the dealership is not going to volunteer this information. The manufacturer's website is not going to tell you that your Utes segment is under pressure. The work of figuring this out falls on you, and the right time to do it is before the depreciation curve has done its worst. Check your current trade-in value against what you paid. Check the private sale prices for your specific model and year on the major platforms. Compare what you see today against what the same car was fetching 12 months ago. The numbers will tell you everything you need to know. Drive safe, sell smarter, and for the love of everything mechanical, check the resale before you fall in love with the badge.